Welcome to In the Balance, the podcast to help you build your dream team of experts to make your financial goals a reality.
G'day, how you going? It's Phil Tarrant here. I'm the co-host of In the Balance, joined by Munzurul Khan, co-founder, chair of KHI Partners. Munzurul, how you going?
Very good. Thank you very much. Thank you for having us, Phil.
Here we are, back again. It feels like we just recorded the last podcast and another month on, we're recording another podcast. So
and it was a good one, right?
It was good.
Because we discussed quite a bit about the economy and we debated in the open wall in terms of where the interest rate would be. Mind you, Donald Trump wasn't there at that stage.
No, he wasn't. So lots has changed since we have a new president. So soon to be inaugurated in president in the US. I think there's a baseline acceptance that there's not going to be any interest rate cuts in early of next year now, and my call, Munzurul, put it out there, I think we'll get one interest rate cut next year, and it's going to be towards the back end of next year, would be my view. I don't know, a lot of people probably don't want to hear that, mate.
Yeah, no, I tend to more agree rather than disagree now, because if we were to speak about, say, month and a half ago, I was going to say more towards about February, March, April, and maybe at maximum, say, May, June was the view. But it sort of seems that it's sort of moving quite a bit. Now, saying this, I was speaking to a couple of the real estate agents this morning and very large real estate agents. There seems to be a lot of hard money at the moment, and quite a bit of hard money that sort of the cash buffer is sort of running out. So it again goes back to the Australian economy, is that what is that fine balance? It appears towards the end of next year, but is it a bit too late? We'll see.
Well, the RBA is often criticised that it's often slow to rise rates and slow to cut rates. So this logic of saying they should start cutting earlier. Now, I don't know if you picked through the RBA minutes the other day. It's very opaque. It's pretty much going, yeah, we'll do what we need to do when we need to do it. There's no indications whatsoever. And I know a lot of the major banks now are shifting their assessments of a cut to May. We need to remember we're going to have the federal election sometime in the new year. I originally thought it was going to happen in December, but things have changed. So that's I said that sort of 4 or 5 months ago. So I don't think we'll get an interest rate cut before the federal election.
I think it's the Christmas, right? So we're all sort of waiting some of the data on the Christmas, that how much are we going to spend over that Christmas and what's that impact of that would be on the inflation, right? And then we sort of say is that, well, are we getting in within that 2 to 3%, but is it more sort of the normal, or is it because of some of the incentives that government has provided? So there's still a bit of uncertainty, but it definitely has pushed a few months at a bare minimum compared to, say, a couple of months ago.
It'll just keep pushing forward and forward and forward and forward. I think it's going to be creep, right? There'll be creep out into the latter part of the year. But you mentioned sort of colloquially, anecdotally, chatting with real estate agents. So people are looking to sell. Like it's now starting to bite, like generally starting to bite, holding on to these higher interest rates for longer.
It's hard market at the moment, and the general view on the market is that there's quite a bit of a stock coming through on the market, and the price has taken anywhere between 5-7 up to 10% sort of bit of a hit. And one sort of looks back and one sort of say that this sort of period of the time is that things get sold a lot more, right? Because the spring and sort of before the Christmas, but not exactly on the Christmas, but it's definitely not there. So the general view is that after the Christmas is that there could be quite a bit of stock coming through. So from a buying perspective, January, February next year could be a really good time.
So you think there's going to be a glut of stock on market and the buyers probably still sitting on their hands waiting for an interest rate cut to pull the trigger. We're going to remember when interest rates do start coming down, they're not going to come down at the speed at which they come up. And I think there's this misnomer in the market that interest rates are going to start being cut and it's going to go back to this sort of period of 2 to 3% interest rates. And that's just not going to happen. And people need to really reframe and realign exactly how they see the world, and acceptance that interest rates may hover 75 basis points lower than where they are today, maybe a full percentage point, but this is the way it's going to be for the foreseeable future, that you're going to have interest rates, probably, not thinking about the cash rate, but you're going to have interest rates starting with 5s.
I mean, a couple of things, right? I mean, one is that first bit of the interest rate drop, and we spoke about that in the last podcast as well, that has quite a bit of a psychological impact. This is where we all draw a line saying that is it the end of it? But at the same time, how do we know that's the end of it, right? Because if the interest rate drops rather early, then there is always that risk that the inflation sort of goes up and you sort of go back and have to restart that again. But you're right, even if it drops, it's not going to be dropping instead of 0.5 and 0.75, it would be 0.25. And how many of that 0.25? Is the bank going to pass that? Is the bank going to pass that entire 0.25, right? That by itself needs to be seen. So there's a few things here.
Yeah, and I've been very vocal around that for property investors. It's obviously a podcast for people who are looking to create wealth through property with an appreciation of the team you need around you in order to be successful with it. Just because the official cash rate change doesn't guarantee that your bank is going to pass on those savings. You're going to end up in the same situation of going, well, Bank A passed on 15 basis points of a 25 basis point deduction, and most of the banks will sit there looking at each other, see who blinks first, and they'll all follow suit. I wouldn't, it's not guaranteed by any means, but I'm just not even accepting or assuming that the banks are going to be passing on interest rate cuts if they can get away with it.
And the rents we've seen that the rents increased quite a bit over the last year to year and a half. And I think there is that demand of that rent increase will still be there. But the question is that how do you compare the rent increase as well as that higher level of the interest rate? There is still a gap.
There's a huge gap, but we're not qualified to talk about any of this sort of stuff, Munzurul, because you're just a humble, struggling accountant, and I'm just a humble, struggling journalist and or podcaster. But we're fortunate to have in the studio Frank Wong and Janine Sim from KHI Finance, part of the KHI group and very talented individuals you have there, which I'm getting to meet all of them through the In the Balance podcast. And I think they could probably talk about this stuff.
I'm actually very
more
excited.
More than us.
I'm very, very excited to have both Frank and Janine, and they just specialised. Right?
Well, welcome, guys. Thanks for coming along.
Thank you. Thanks, Phil.
Do you hear sort of guys like us sitting there, armchair economists, giving their views of the world, Janine, and just going, you guys don't know nothing. I know Munzurul, Munzurul actually knows what he's talking about. I just go, I reckon this, you know.
No, I love it. I think that the investors need to hear people that are on the ground, and that you guys are actually investors and you see it live in your portfolio. So I think you definitely have insight. It's real insight, not allowed to impact from what comes out, I guess, from data as well.
So I'm not big on CVs and stuff, but I think let's just give a bit of background to you guys. Jenny, I'm going to kick off with you. You've been at KHI for, I imagine now, probably about 2 years?
Probably 3 now.
Is it 3
coming
years?
Up on 3, yeah.
Wow, okay.
Yeah.
But you weren't always working in and around the sort of accounting and mortgage broking space. You were once upon a time a suit-wearing banking person, right? I won't hold that against you.
That's correct, Phil. I've been 10 years in the bank. So I was a corporate and business banker at CBA. And then just before that, I was about 3 years in Macquarie as a senior banker. I had the pleasure of Munzurul being my client.
Oh, is that how you know?
Yeah.
Oh, that explains a lot.
So that's how we met.
At CBA or Macquarie?
At Macquarie,
okay.
Yeah. That was my last role before I jumped in with Munzurul. We had a chat and, the rest is history, really. So
okay.
Here we are.
That's very cool. Well, you have a lot of scar tissue, I would imagine, if you've been Munzurul's client. But what I would say, therefore, a lot of experience, and you've probably seen most things, which no doubt is of great value to your clients. So essentially you're Munzurul's mortgage broker, is that?
Yeah,
okay.
yeah. I was his banker and turned mortgage broker. So
okay,
yeah,
God.
for life,
all right. Well, I hope you get trauma leave every now and then from work, because I know Munzurul's portfolio and it probably needs some sophistication. And Frank, you've been probably at KHI now for
It's coming up to 5 years.
Coming up to 5 years.
Yeah. Yep.
Wow.
Yep.
God, how's that happen?
And Frank was our first mortgage broking partner, right? So I still remember in day one when we sat down with all those different projections and everything else, and then a whole lot of learning, and here we are after 5 years.
Yeah, guys. And where were you before mortgage broking?
So I've been mortgage broking since 2016.
Okay.
So I took a different route into mortgage broking. So prior to that, I was actually working in the engineering field.
Okay.
And just had enough of that career. And through my actual mortgage broker, I found mortgage broking myself.
Yeah, it's a lot of people find their own way into mortgage broking, and I typically find that people find their way into it, really enjoy it. They really get great satisfaction out of helping out their clients. It's this sort of, mortgage brokers can make good money and stuff, but it's more of the altruistic sort of aspect of it where they can generally see people get in the house. I know you do a lot of owner-occupied as well as investment stuff, Frank?
Yeah, that's right. So, yeah, it is a very rewarding, career. And one of the things that resonates with me about this career is, you're right, it is actually about helping people. And I always reflect back on, my family and what mortgage broking actually is. It's not so much just, getting somebody a loan. I mean, look, you can go to a bank and get that, but just looking forward to, people can be on a hamster wheel their whole life, working their careers, and then, when they retire, sometimes you look at it and think, well, when I get to that stage, I really want more options. And sometimes people can find themselves in that position because they didn't have that person in their life to guide them through that. And, a lot of us, we've been very fortunate to meet people and gain that knowledge. And, it's really great to be able to share that with people.
Do you think you'll ever do anything else other than be a mortgage broker?
I can't imagine anything else.
No.
Yeah, best job in the world.
Well, it's changing quite a lot, and I'm very pro broker, and I've been chatting about it for years. Why would anyone want to go directly to a bank branch? I can't think of anything worse. Every time I actually get anxiety when I walk into a bank branch because I know I'm going to be dissatisfied with the outcome. Right, and I'm not a bank beater upperer, but particularly when it comes to mortgage finance, you'd be mad not to be using a mortgage broker. But you were a career banker, become mortgage broker. Like,
Thought I'd never leave.
In journalism, they say, what do they say? You've gone to the dark side is when you become a communications type specialist or a marketer. The bankers go to the dark side, and that is mortgage broking.
Yeah. Look, broking was a dirty word in the bank, ironically.
Yeah,
so
God.
I think it's really changed a lot. I know a lot of my colleagues have actually become brokers, and I think they see the value, and I think that's actually changing the industry, hopefully as a whole. There was a sort of a negative stigma, but I don't think it should be like that. And I think it gives the customer choice. They can go and choose so many different lenders and have options to solutions that they never thought were possible, really.
So your introduction to mortgage broking was at Munzurul, but I imagine that's probably the pointy end of what mortgage brokers can and should be doing for their clients. How complicated is Munzurul's borrowing?
Yeah.
Without delving into too much.
No, I don't want any
he's-
details.
he's,
But
it's quite complex. He's got on a high level multiple trust structures, and on top of that, trading business structures with many different ownership structures, and on top of that, a very large portfolio of a mix of resi and commercial assets. And so it's not easy. You can't even go through a normal. Obviously, it's not going through a normal channel. DTIs don't even apply to him.
Yeah.
It really have to look at it, the whole portfolio in a very different way.
And so you're going to be super strategic in pretty much everything, Munz.
And the beauty of it is that the way we do it is that we sort of simplify a very complex matter, right? We simplify a very complex matter, and that's the fundamental with the mortgage broking. It's a storytelling at the end, right? And it's a storytelling in the sense that you've got the credit, and the credit needs to pass through. Yes, there is a science behind it, but there is also that bit of the art side of it, right? So when you say DTI as an example, it doesn't apply. There's some standard DTI.
Some people might not know what DTI is.
Yeah, so that's debt to income. So that's basically your debt, like how much debt you have, and then your actual gross income, and that's as a function of each other.
So it becomes irrelevant at a point in
It
time.
does, yeah. It's actually irrelevant for Munzurul. We don't even consider it.
No.
I think we really try and simplify his portfolio, and fundamentally every loan, whether you're a mum and dad investor or have a large portfolio like Munzurul, is like, where is the money being earned, and how can we explain the actual income flows, and what are the actual commitments, and explain that. And we need to break that down in its simplest form, even in its complexity. So it's about presenting, I guess, that story back to the lender.
Yeah, and I know both of you work with sophisticated investors like that, but also investors who are just kicking off, and we get into some of those strategies around it. But with sort of more sophisticated property investors, what's important for you, Janine, in terms of being able to work for them effectively? Is it access to information and your ability to synthesize and interpret? Is that the key skill?
Yeah, I think it's firstly really understanding what is their long-term goal, because for them it may be, I want to grow my portfolio to X number of properties, or I want to diversify. Maybe they're in resi and they want to get into commercial. So it's like, how can we plan to get into that? So for me, it's understanding that, and then I can work backwards from there to really understand, and we'll plan accordingly, really.
So how different is working inside of were you in private banking or business banking?
In the business bank,
How different is it working inside of business banking and serving business clients versus sort of being a mortgage finance expert?
Yeah, I think there's parallels in that we are dealing with business owners that run their trading business, which needs lending, and then we're also trying to also build their wealth on the side. So it comes together. But I think as a broker, when you're sitting in a bank, you're only restricted to that one bank's policy. So you need to make it work for that bank. And in some cases it doesn't. It's not that it's a bad credit, but as a broker, we have. I think everyone can get it. There is a solution for everyone. So if your portfolio is complex, we can actually work it with multiple lenders, perhaps, to actually get you the best solution.
And how do you measure success, whether you're doing a good job? I imagine Munzurul probably just walks in the office and knocks on the door and goes, I bought something on the weekend. I need a home loan. Yeah. Is that how it works?
Yeah, there's no such thing as finance courses in Munzurul.
Okay.
It's irrelevant.
So there's no pre-approvals?
No. None of that.
So everything you're hearing, people, don't do it. Don't do what Munzurul does.
Don't listen to her. Yeah, this is a very unique case. I think for me, it really is rewarding to see. Look, I've dealt with, I think, the business owners, and then we're seeing the generations come through. So they may be, grandparents, and then they've passed on to the second generation, and now their kids are coming through. And we're really seeing them put in structures in place that actually benefit the next generation. And I think for me, that's rewarding. So it's not just about building wealth now, but how do you plan actually for the future generations? So
I think, Phil, there's many mortgage brokers, right? And there's many finance solution partners, so to speak. But what makes someone very special as opposed to a standard sort of a mortgage broker? There's many things, right? Number one is listening. Number two is to really understand the goals and objectives which you're saying. And number three is that being very resourceful on the solution base, right? Because there's always a solution. And sometimes it could be a bit more pricey. Sometimes the terms and figures could not be there. Right, but it's that product knowledge. So when you sort of say that, I can't imagine of us going to the bank. And the reason why we can't go directly to the bank is because at the end, they still have one set of products as opposed to you've got that entire finance, right? You've got the major, you've got the outside major, you've got the private lenders, and very often it's a combination of it with a complex matter.
So mainly your skill set, and Janine, and this would apply to you as well, Frank, is the creativity around packaging deals to satisfy needs of lenders. That's so that there is a real degree of, this is the art I think you spoke about, Munzurul. There is a lot of creativity there. Yeah. And the only way you can really learn about that creativity, you can't have your head in the books around what policies and what you got to essentially you're putting jigsaws together.
Yeah, that's exactly right, Phil. I think the sort of the nature of the clients we deal with, like, quite large family wealth in a way, and they have many different arms. It's not as linear as just they are really trying to plan for generational wealth and how do we pass that on in terms of lending and structuring. So I think it really is. I would never describe myself as a creative person. I do maths, but I feel this is my only creative outlet. Is trying to find a solution through.
And when you get an approval, do you sit there and just go, yes?
Oh yeah. It's so rewarding.
Have you got a siren or something or other? Or
I wish I had a bell.
You've got to get a bell, Munzurul. Get a bell. Get a approved bell or something or other.
Yeah. And when we speak about the creativity, or we speak about the being resourceful, so there's many examples, right? So from the funding side of it, I suppose, is that we've got that valuation, right? So you've got a loan to valuation ratio and you've got the DTI, debt to income ratio. So we need the serviceability. And very often with the same bit of the numbers, depending on how you present, depending on how deep you go to the story, your serviceability could be very different.
Yeah, no, that's absolutely right. I think I had a scenario of a client and he had gone to, maybe a more residential broker. He could get out maybe 500,000, but we sort of restructured his portfolio in a way through a major bank, and he was actually able to buy a commercial property of $5 million through that. So,
that's a big difference.
Yeah, it was a material difference.
God.
But we worked with the bank, and they have a special sort of product that we can leverage. But there's so many options.
So what other people don't know. That's pretty good. That's pretty smart. And speaking of knowing what other people know, Frank, chatting about, and we're using Munzurul as an example, and there's a huge cohort of investors with large portfolios with multiple ownership structures, and the ways in which they generate their income is quite fluid, and often banks need help to actually understand that. So we're speaking about one end of the spectrum, but the majority of property investors in Australia own between 1 and 2 properties. It's sort of more meat and potato type stuff, which still requires a big deal of structure and strategy around it. But I want to get your sentiment on this, because I've been chatting about it a little bit, and I think it's been hijacked a bit as a concept and maybe a little bit unnecessary. Every single property investor these days seems to be investing in a trust. Are you seeing that?
Yes.
I'm generalising there, and I was being quite flippant in that,
Right.
in the way I package that. But what's going on?
Yeah, so look, there is a lot of noise about this, and to be honest, like what that strategy is, it's nothing actually new. It's just becoming a lot more prominent now as you see a lot of people hitting their borrowing capacities, right? So generally speaking, again, we're not giving any advice today. Everything we're talking
There's
about
our disclaimer.
general
It's
nature.
just four people talking about stuff in general.
right.
Yep.
Yeah, so some people use this as a bit of a vehicle to possibly preserve some of their borrowing capacity and be able and they use that as part of their strategy to build their portfolios essentially. And how that's really working is, if they're buying property and borrowing in a trust structure, if that trust is actually self-sustaining, it's a way to be able to have that excluded from certain
So
assessments.
trust being self-sustaining means that it's not at a loss. It's every time you do your tax, there's a surplus in there.
Yeah, well, I think we can ask Munzurul that question of what he likes to see to be able to declare a trust self-sustaining.
That's right. I mean, the
Look at that. You see what he did there? He
Just passed it back.
but referred the right. This when and the point is mortgage brokers, really effective mortgage brokers, worked really effective with accountants, and there's a point in time when a mortgage broker is going to go, this is the extent of my remit. I'm conscious of this. I'm aware of it. This is when we actually need to go to a professional tax practitioner or accounting practitioner to give us the advice you need. So exactly what you did was perfect.
Thank you. So the self-sustaining trust is that the trust needs to be positive at the end, right? Trust needs to be minimum $1 or so or higher level of the positive.
For the year or no
the
carry
year.
forward losses?
For the year, right?
Okay.
There could be carry forward losses, but for the year, this is the year that's what the profitability. The challenge, Phil, is that there's many things can happen which can make the trust being in loss, right? So you bought this property on the face value of it is that you've got a house, you've got a granny flat, it's meant to be positive. You bought a commercial property, meant to be positive, right? But you may have a whole bunch of one-off expenses as repairs and maintenance, which makes it negative. So my view with the trust side of it, yes, in theory, there is a lot of merit to it, but one got to be very, very careful how we utilize it and not overdo it.
So why is it then everyone is now investing in investment properties through trusts? And you say people hit a serviceability threshold. Wouldn't that be the signal for most people to say, well, you can't afford any more property, you're going to have to sit around and wait or get a pay rise? Why does everyone? What is the mindset shift to people now going, I want to keep going, I'll find various ways in order to do it? Because I don't like seeing people getting to a point where they, and I think you referenced it earlier on, Munzurul, where people are now generally starting to hurt and people are selling properties. Like people are selling properties, investment properties, because they probably hit that threshold where even though they might have these complicated and sophisticated structures, you still got to feed it with cash flow.
I wonder whether it is almost your fear of missing out. You're sort of almost that sort of so much noise in the open world that you sort of fall within that noise. But the point is that as you sort of say, is that it's not a new rule. It's been around for many, many, many years, and the bank has got the full right to change that rule at any point of time. So if we just look through recently, there's two banks. One bank went in quite a bit in positive, one bank went in quite a bit of negative, right? And this sort of things can happen quite a bit, right? So this few publication came in, people sort of jumped into it quite a bit, the fear of missing out, and it just compounded.
Yeah. There you go. And you see, like, you dial into your social, and I'm not dismissing trusts as a sensible vehicle for certain investors to hold investment properties. I hold all of my properties inside a trust for various reasons based on very good advice from my accountant. But that might not necessarily be the best pathway for most investors, particularly people who are new to investing.
Yeah.
You must see it, Frank, people coming in saying, I want to buy an investment property. It's my first property. Can you put it in the trust?
Definitely. They listen to a lot of those podcasts and it all sounds great, but this is, the type of client we've got to go on a bit of an education journey, right? Because it can be a very, very useful vehicle, but for the right circumstances. And it is not for everybody, but for those, it can be quite viable.
Yeah, and there's a lot of additional costs investing in a trust, which a lot of people, they might like the idea in theory, and they might be thinking about And we speak about it on this podcast, Munzurul, where most investors I know who have large portfolios didn't set out to build large portfolios.
No.
So a lot of the work, and you both must see it, is fixing poor structures for people who can actually continue to invest in property. It's the other end of the spectrum now, where people are thinking about, maybe it's good or bad, going, I'm going to build a large property portfolio, so therefore I'll start investing from property one inside of a trust because it will probably be the structure I'm going to end up being in anyway. That's fine, but there could be a period of time when other things happen and you never sort of expand your property portfolio, so you're holding properties inside of ineffective vehicles, and it's expensive. Like, if you're investing in trusts, there's no land tax sort of thresholds or whatever. You're paying full freight from the get-go. And I think this is where the education piece lies, Buns.
That's right. And this whole podcast series and for the audiences that you and Alex came up with the name, and we love that name, right? In the balance. And that's exactly what it is that it is in the balance of making the decision. So we as an accountant is that when the client comes in and client sort of says, well, I'm buying the very first property, I want to buy it on trust, we never sort of start with a yes or no, because each individual circumstances are different. There are some exceptional circumstances that one should be buying day one on the trust, but more on an exception circumstances, someone who's got a very high risk profile and someone very extraordinary circumstances. So what we do is that we go through pros and cons. There are negative. Negative is that your establishment costs, some additional land tax in New South Wales. There's no threshold in Queensland. You've got a lower level of threshold. In Victoria, as an example, you pay surcharge, right? So all those the costs that we take into account, if there are losses, then that whole thing sort of falls as house of cards, and you can't utilize those losses as well. Now, saying this, there's a whole lot of positive to it. I personally have number of trust. I'm a big fan of trust. So it's not so much the merit of the trust that we're questioning. What we're questioning is that what is the time and the place of that trust? Do we do that in day one? Or we still go through with the first property, get some negative gearing, get some land tax threshold, build that up a bit, and then we go into a bit more complex structure.
Yeah, and I often do it, and I'm sort of part of sort of the way I'm wired, but I think a lot of people at the front end overcomplicate things with a view towards the what-ifs at the back end. That's okay. But simplicity is key, I think, when it comes to property investing. And the least amount of tax returns that you have to do every single year, the better off it is for absolutely everyone. Unless you're very methodical and organised, that can become very bewildering for people when they end up with multiple structures with multiple lenders and multiple ways in which they have ownerships of them, and it gets very, 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 very confusing. So just beware would be my counsel for most people. Don't overcook it at the front end. It can be simple. And I would say, I don't want to generalise, we're not providing advice, Munzurul, but typically most people will buy their first or second investment properties in a personal name.
There's a lot of merit to it, right? There's a lot of merit to it. I mean, the first property, whether it is your principal place of residence, individual name, right? And the next couple of properties, whether it is also individual name, not on a joint name, individual as such. Once you buy 2, 3, 4 properties, is that logic behind it is that by then, generally speaking, you've taken away the land tax threshold. You've also utilised some of the tax benefits as such. So those two negative, what we have on the trust is that you've already utilised those two negative, right? So that's where we go into the trust. Why do we do? The traditional reason why people used to go to the trust are two. One is the asset protection, because you don't own it, you control. And the second is that you've got the tax flexibility. So once you sell it, or if it becomes quite positive cash flow, you can distribute the profit on a discretionary in nature. So that was the traditional reason, right? Asset protection as well as the tax planning. This whole finance, it sort of came in quite strongly recently, even though the rules were there for many years.
Yeah, and this is, again, the closer you are connected with mortgage brokers and capable mortgage brokers, the better outcome you're going to get, because they're going to know, they're going to expand your consciousness around these type of things and be able to strategically and tactically help you do that. And you probably see that when people start deviating out of resi properties into commercial properties. Frank, you're doing a lot of commercial stuff these days, and because there's very different lending requirements around it. I've sort of got some commercial property. I'm looking to get quite more, but you can invest in isolation a lot more inside of commercial properties.
Yeah, it's definitely on the rise as people are hitting a lot of capacity issues in residential. So commercial is definitely a lot more popular these days, particularly without naming any banks. The lease stock product is becoming more and more popular.
So lease stocks have become more popular. So explain how a lease stock works for our listeners.
Look, to simplify it, essentially most of the assessment is done around the remaining lease and the tenant. So it's excluding typically most of the personal circumstances of the individual.
So if a bank sees a contract of sale that says there's a sitting tenant that's been there for a long period of time, there's still a long term left on the lease with an option for continuance of the lease and positive cash flow, I would imagine, based on the dynamics of that individual property, they're happy to finance against the basis of that as the asset and the security.
That's right. That's right. And there's certain metrics that income has to pass. It varies from bank to bank, but essentially, yes.
So I imagine you probably also seen, we're talking about trust-based lending when people hit these serviceability thresholds. So, to Munzurul's point, the traditional use of a trust is still as relevant today than what it is, but it's just now amplified by this idea that it can actually help people accelerate their borrowing through trust lending. Same applies in SMSFs. What I see is that you're more mum and dad investor. I don't really like the term, but it's a bit colloquial. But they'll buy their first couple of investment properties in their own personal names. They'll hit that threshold on serviceability. The next step will be not trust lending. Normally you should set up your own super fund.
Yeah, so again, that's becoming more and more common as well. But I think that's something that they need to really speak to a professional to understand, is that appropriate? Because in our experience, we found that super fund purchasing a super fund and borrowing might not be appropriate for everybody. So it's really important they speak to the right professional before they make that decision.
So this again, it's sort of maybe towards the front end of people's investment journey where they're still building out their portfolios until they go down a pathway of it's not a bell curve in property investing. Everyone's sort of one or two properties, and then it gets sort of smaller and smaller and smaller till you get to points where you get portfolios probably like mine and yours, Munzurul. So there's a lot of strategy around it. But it comes down to really good financial management, budgeting, administration, responsibilities around it. While we've got the four of us in the room, I'm going to turn to each of us to ask for a top tip for increasing serviceability, because that's what it's all about. I'll start. Cut up your credit cards.
Yep, definitely. Take away any of your personal loan because they come in as sort of a shorter term and it takes away so much of
credit cards, car loans, store cards, all this easier to access credit can really impact your ability to borrow higher amounts. So that's budgeting, or that's finance sort of 101. But Frank, what's a hot tip for increasing your serviceability? I'm going to be looking for you guys for something super sophisticated as well.
Yeah, look, we'll go around, but one of the tips could be just revisit your existing loan terms, remaining loan terms, right? Is that something that you could extend back out again? So that's one that can...
We're talking to refinance.
Yeah, correct.
So you refinance out another 30-year mortgage.
Yep, correct. And in most cases, that can actually improve your servicing. So
that'll be that's a full application and everything? Yep. Refinancing with your current lender or moving out somewhere else for better terms?
As mortgage brokers, we always like to look at the existing lender, because if it can be done with the existing lender, you can save a lot in refinance costs. But if they're not the ones looking after you anymore, then we definitely look elsewhere.
I see the news out today was the serviceability buffer is going to remain. There was sort of some, and what we're talking about there is this APRA, the prudential regulator, pretty much putting 3% on top of all serviceability calculations to build a buffer in there for Australian borrowers. So the serviceability buffer is remaining. Do you think we'll get back to the point where you could just call your bank up at the end of a 5-year interest-only term saying, oh, can you just extend it for another 5 years? Or you reckon that it's never going to go back to that? It's going to be full application each time?
Yeah, I won't name them, but there is a lender that lets you do that.
Oh, is there?
Yeah, yep.
Who is it?
Yeah.
What colour is the logo? Are they a major lender or
I decline to answer for you.
Okay. Well, I want to ask you guys about lenders, but anyway, we're just going to stick on. That's intriguing. You're not going to... All right, I'm going to find out, everyone. I'll let you know. Are they rates competitive?
They can be.
Look how cagey mortgage... When do mortgage brokers become cagey? Right, you got to know. Your brokers should know, but increasing serviceability. Janine, what do you got for us?
I think in the right situation, you could explore a second tier lender. And what I mean by that is, not the majors or the big four that we know. You will be faced with higher rates, but for the right client, and depends on the type of asset and the situation. I think
So second tier being like a non-major?
Non-major, yeah, or a non-bank.
A non-bank.
Yeah, because
like a Resimac or someone like that, or a Pepper or a Liberty,
that's
this sort of cohort.
Yeah, you'll find the rate differential is probably 1 to 1.5 on top of what you would normally pay. But servicing can improve by sometimes up to 20%. That's
just the cost of doing business.
Yeah.
And that's when you start seeing more sophisticated investors coming in, but they don't worry so much about the rate. It's about getting the deal set. Smart. Muns, what's your serviceability tip?
I think I agree with all of those, right? We started with some of the simpler ones, that whether we take the personal loan, credit cards, whether we refinance the entire loan, whether we go outside to the some of the second tier as such, right? One of the things which we do very well between Frank, Janine and myself, we as a team, is that when a sophisticated client comes in, is that we take a step back. We say, let's develop the entire financial accounts and let's do it in the right way. And right way, all is staying within the rules, right? So there is that storytelling in terms of the bank side of it, but there is also that presentation. To give you a couple of examples, that a client may have corporate entity, trust, and a whole bunch of other properties as such. First thing is that we simplify. We look through the standard level of serviceability. We say, well, the serviceability doesn't work. Then we say, well, how do we increase the serviceability? This is where we go a little bit deeper with the numbers. This is where Janine and I, we discuss and we sort of say that, well, the standard superannuation contribution was 11.5 or 12%, but the client actually paid the maximum super. They didn't need to pay the maximum super, but they paid the maximum super. So if we present that to the bank that, well, the client had an obligation to pay 15, they paid 30,000 as an example, then the bank will add back that 15,000.
So this concept of add backs, where you could just go, under normal trading conditions, this wouldn't be there, this wouldn't be there, this wouldn't be there.
Similar example could be is that if there is an amortization, if there is a depreciation, you add back all of those. Similar example could be is that if there are extraordinary expenses, bank can add back all of those expenses as well. And similar example could be there could be a timing difference, right? That yes, okay, have I done the set of accounts on a cash basis or have I done the set of accounts on an accrual basis? Under the tax law is that based on the circumstances, I can do both, right? But if I do it on an accrual basis, as an example, I'm bringing in the debtors. And these are all genuine, right? The client sort of did the invoice didn't get paid, and I record that as a revenue, I record that as a data from bank's point of view, the serviceability increase. So I think sometimes very often is that when we work together as a team, now there is a tax consequence to it, right? On that example is that if we do it on a cash basis, the net profit could be lower, and based on the net profit lower, the tax is lower. But perhaps we need the accrual basis on that example. And if the client make a conscious decision saying that we understand there is a bit more tax, we understand that there is a timing difference with this tax, because what we're bringing in this year is that we were always going to bring that in next year anyway. So it's working together as a team.
So what I hear from this is I'm going to put aside the other professionals like maybe financial planners or buyer's agents, but what we're talking about here is the broker accountant relationship, and what I'm hearing from this is that you shouldn't do either of them in isolation. So if you're making accounting decisions based on how you would choose to present your financials within the letter of the law, you should always have some broker lens on that with a view towards what you're trying to achieve, and vice versa. You shouldn't be chatting to your broker in isolation of your accountant, because your accountant's going to be integral in helping to frame your financial position as effectively as possible to support the broker to give the best application possible.
And particularly when there is a sophisticated, the investor as such, right? I mean, you asked a whole bunch of questions to Frank in terms of the commercial property. And we spoke about the trust, and we said trust has some benefits, some negative, right? But if it's a commercial property and if it's a lease stock, it's probably more common for it to be on a self-sustaining trust. So that's an example that we actively will establish a trust because it is a commercial property, right? So if it's a sophisticated investor, it is always a team effort which gives you the best outcome.
So what I'm seeing a huge theme at the moment is, and whether it's because of certain cohorts, a lot of money washing around, access to private debt is growing quite a lot. And there's a lot of sort of family offices who are putting money into these type of products moving forward, and or sort of PE or venture capital type stuff. But access to private funds is rising. I imagine you're probably seeing a fair bit of that, Janine, when it comes to development funding. Can you give me a sense for the emergence of sort of outside the majors or even outside the second tier? There's a lot out there that a lot of people don't know, where when they get stuck or in a sticky position when it comes to trying to set a deal, there's a lot of options.
Yeah, specifically for development funding. Yeah. I think we're seeing some of the majors, they really want to see that you've got experience, like both in executing on a certain type. So if you're building townhouses, they want to see that you've built, 4 townhouses before. You can't really just jump from being an accountant that's had a good portfolio, has surplus cash and wants to build. So the majors really want to see that experience on the books. But the second tiers and probably the non-banks, even some of the privates, will take a sort of slightly different view. So they just really want to see that you probably have a good builder, and that and they sometimes may want a project manager as well that can actually manage that process for you if you don't actually have experience yourself.
So this is one of these catch-22s. You need to get experience to get access to more money. So you need to start somewhere, and that somewhere's probably
that's right.
paying a bit of a premium. With private lenders just to show how much of a role is it from an accountant or even a mortgage broker to say, don't do that development, you're going to blow your dough? Because let's be clear, you only hear the successful development stories. There's a lot of not so successful development stories, and people who are not so successful developers don't choose to sing from the rooftop that they're not very good at it. So I'm not going to say most developments go sour, but a lot do.
Yes.
A lot do.
Yeah, I think, look, up front, when we do a development, we have to get a feasibility up front. And the lenders generally want to see a minimum profitability margin. That margin.
That's based on pre-sales, right?
Well, no, it's actually
Assume
based
pre-sales.
on... Yeah, so some of the lenders actually need pre-sales.
Okay.
Some actually, like some of the second tiers, but they're working that there is an exit strategy in place, not necessarily holding you up with those pre-sales up front. So in that respect, I think it's really working with the broker and the accountant. So thankfully we have an accountant in-house who can give advice, and give them more structure. We can look at the numbers and be like, oh, look, just based on what we see, the profitability doesn't quite make sense, and it's not going to be enough for what the banks actually need, or the non-bank. And then perhaps to redo the numbers or get a professional to actually run the feasibility properly. Just to make sure, and making sure they have the right team around them, because it's really important, as costs, as we all know, blow out really quickly in construction, and you start dipping into contingencies. And
it's slippery slope, it is a Munzurul.
Yeah. You almost have to have the business plan as well as the finance plan, right? Yeah. And the business plan is to make sure that all the costs are being included. So it's not just sort of buying construction and sort of selling cost. It's the holding cost attached to it, right? It's all those interest, all those sort of the council water rates and the land tax, all those bills that sort of adds away, right? And then you've got to add away the contingency in terms of, well, what happens if the market drops by 5-7%? What happens if I can't sell it within a period of time, right? All of those. And then you look into the finance cost side of it. To give you one example is that I've got a large client, very large client, who built an entire retirement village. So when the clients sort of built the retirement village in day one, they bought a big land, and the land was at a stage that there was no infrastructure behind it. So none of the big four would be doing the funding. So we actively went to a second tier to get that initial level of the funding just to do that infrastructure. We've done the infrastructure, got the DA, the value improved quite a bit, refinanced the whole lot into the big four, and then we started and we did all of those construction. So there was an active cost being taken into account. So that's a good example that you use that private funder as well as the big four. As long as you do it in right, planned way, there is a time and place for both.
So it sounds like it's very sequential. You've got everything sorted out and in process and very strategic around it. What I would say about it, people always go to me, why aren't you developing properties? And I go, well, I'm sure I could. I would be able to do it, but I don't have the time. I don't have the bandwidth. I don't have the capability right now. A lot of people get pulled into this idea of making money quicker, inverted commas, in property investment through developing. When I would say most people shouldn't be developing properties, much like most people shouldn't go into business for themselves. There's a good reason why most SMEs, small businesses, fail. More than half of, I think, Munzurul, you probably know more than half of small businesses fail in the first 2 years. There's a good reason why. Is because most people, inverted commas, people probably going to dislike me saying this, probably shouldn't be in business for themselves. And I would say exactly the same thing for people considering developing in properties. The likelihood of it going wrong is high.
And I've seen so many of those examples, that Frank, Janine, that we've seen, that a builder sort of halfway through and a whole lot of things goes wrong and builder can't complete. And this is probably the worst case that a builder can be. Because once you're halfway through a funding, you virtually can't refinance to anywhere else, right? Very difficult, right? So, yeah, no, absolutely.
What about private lenders? Like, this is just family office dough or essentially that's what it is, and managed by someone who are lending it out. You see a fair bit of it.
Yeah.
Why is that growing, do you think, so much?
Yeah, I think we're seeing a lot of appetite for the private lenders. I think in some of the clients that we deal with, a lot of them, there's a time and place. So it could be maybe that they've sold their business, so they don't actually have income, so they can't go to a major bank, but they're asset rich. So they've got assets that they can lend, and they know that there's a clear exit. So the big thing with private is you need to have a clear exit strategy. So that could be through the sale of another asset, or you could be banking on a potential uplift from putting a DA, and you're going to get like significant profit from the asset, and that would actually reduce the debt. Or sometimes you're land banking, trying to buy a site to build townhouses or something. So it's a short-term lend, but it makes sense for whatever whatever project or investment you're getting into. So the higher rate, you almost count it as your cost of investment, and then you work that back. And then
so what sort of premium are you sort of paying for private? Because I know we've got a sort of shared friend who I know was doing a development. They're paying 10%, I think, on their day. This is back when everyone else was probably getting 3%, right? Like, it was a pretty significant premium in order to get the deal done to a point it could be refinanced into more, and it just sort of as a cost of doing business.
Yeah, that's probably right. It's probably anywhere from 10, even up to 20, depending on the type of asset. And the upfronts are probably up to 3%.
And it can get a bit messy when people don't repay their debts. Yeah,
you got to be careful you've got to really read the exit clauses and how they're exiting.
Because they'll tie up lots of collateral and they'll come after you and take the family home potentially.
Yeah, we'll try and limit it to the SPV or the special purpose vehicle
that they've set
SPV. Up, ideally. But there's a time and place for it, and really more on that short-term funding. It's not obviously a long-term solution, but it really can serve a purpose.
Yeah.
And Janine, would you say that there's this whole sort of finance plan that we do, there's almost an order to it, right?
Yeah.
We always start with the big four, or do we start with the big four? Whether it works, do we go to the second tier, do we go to the private bankers? But in the medium to longer period of time, you always want to come back to standard banking, right?
That's right. Yeah, I think when you start some of the more sophisticated portfolios, if you call it that, they sometimes just want access to an asset, which doesn't quite make sense from a major bank from their metrics and how they're reviewing it, but it could actually really make sense because from a private lender, they're just looking at the asset itself and what are we lending. They're not necessarily checking the income. They know they'll do a lower loan-to-valuation ratio, and they're seeing, well, if you're going to pay it out in 12 months, then
you deal with it.
Makes sense, yeah.
So this is why you need a good broker. What about sort of multi-resi properties, apartment blocks, townhouses, all this sort of stuff, which I like. I think it's good business.
We're seeing a lot of that. I think, particularly in Western Sydney, Southwest Sydney, there's big land lots that can be subdivided. People have been sitting on them for a while. And then they know the next door's knocked it down for a duplex. So we're getting a rise in, I think, duplex funding requests. And I think duplex for two, we can almost write it as like a residential product almost.
Well, I think this is, when you talk about sort of housing supply issues we have in our capital cities, I think the opportunity for the policymakers and the government bureaucrats is to normalise the idea of high-density housing and multi-dwelling housing. That's how we'll solve a lot of these issues, right? But there's still a lot of handbrakes around getting this stuff approved and through the system, even on the lending side of things. So as that becomes more normalised, I think it'll go a long way to supporting some of the housing constraints that we have. Do you ever see any more, and we've bought it before, like a whole block of like apartments and stuff, like do those deals still exist, or they're long gone? Can you still pick up like 10 apartments all on one title out in the western suburbs of wherever equivalent is?
More of commercial lending, right? Because
Yeah.
most of the bank, I think about 3 or 4
3 or
property-
4 is
three
where
or
it
4
sort of tips
properties.
over into
Yeah.
commercial.
Unless you can do it as individual. If they're individual
Strata,
titled.
Yeah.
Yeah.
Sometimes they have restrictions of how many in the building,
Yeah.
even if it's strata title.
Because we've done it
Yeah.
where it's not strata but individual titles, and we're able to
Yeah.
finance them all differently with different banks.
Yeah, if you take them to separate banks.
Yeah,
you'll be able to do
which
that.
is again, it's
Yeah.
sort of gets a bit on the sophisticated side of things. That's pretty interesting. So, because much like sort of increasing your serviceability as a borrower, can you fix your credit history if it's a little bit sort of less so good in the past?
Yeah, look, I think a recent example I've seen, which is real, anyone can happen to any of us. I think we had a client, I think, to focus on your utility bills, which everyone just pays on time. Maybe you have it on a direct debit. What happened with this client is he was renting and then he moved premises, and he didn't know I think he didn't change his address, and so they were still sending notices to his old address, and his electricity bill was 6 months in arrears. And when they called him and said, "You're in collections," he said, "I never even knew I was in arrears." And he said, well, they didn't even send him an email. So I think staying on top of your utility bills, particularly if you're changing from rental properties, and staying on top of that.
When does it hit? When does it hit your record? It's not when if it's in collections, you can still get around it, right? It's only when it sort of hits the register.
In collections, it's probably on. That's generally in that 90-day period is when you're coming on. 30 days, it sort of gets marked. But if it's utilities, it's slightly different to like banks.
Yeah, and you said also, and I must admit, I've done this. I don't know, you would never do this, Munzurul, but and I haven't done it for a long time. But where for some reason you miss a mortgage repayment because maybe you thought there was enough money in an account for it, but there was for whatever reason there wasn't, and you don't know about it, and then you get a letter from the bank saying your mortgage is, like. This can happen to all of us.
Yeah, completely. I think it happens a lot with investment properties, especially because you're probably running an account which doesn't have all your funds in there. You probably run a main offset account, and so it's important to keep funds in there. So
and this when it gets to the point where the more you put strategy and structure in, the more complicated it gets, which means that you need to be a lot better on your administration. You must see it just at that point, Frank, where like a lot of the accounts I have, which will be connected to a property, I just keep enough. I don't want to offset the debt. So I might get it wrong by a couple of $100 because interest-only rates can fluctuate quite a lot on a month, and then you missed your payment.
That happens more often than you would think.
Well, that's good to hear.
Right? And look, it's not always the end of the world. It's never a good thing to have on your credit file. But again, it comes down to storytelling. Like, what is a bank really worried about when they see that? See that on there? Is that are you having issues with your repayments? Like quite often, it can be what we call a mismanagement of funds.
Yeah.
You might have had money in other accounts. Quite often, we can just show the bank that, and it's generally
as long as you can explain it away and it's not a
but if you're doing
a
that 6
repetitive
times
thing
in the last 6 months, it's not a good thing.
Yeah, it's not a good thing. It's and you got to be right across this and accountable as much as you possibly can. Are you sort of priced? So maybe a question for both of you, how you go around this, particularly for SME business owners, and often SME business owners pay a bit of a premium on their mortgages because they might not have their finances ready. They've got to get a low doc type thing or a near prime type thing. But accessing finance if you have tax debt, is that possible?
It is possible. Again, the bank wants to understand the story of why do they have the tax debt and are they catching up. Some lenders actually let you borrow against your property to pay that tax.
So you can refinance, increase your mortgage, and and they wouldn't be majors, right? They'd be sort of second tier and non-banks. So there's typically a solution for everything, Janine.
There is.
Yeah, if you
There
can find
is
it.
indeed. Yeah.
But it's going to get to a point where there's no more solutions available for Munzurul. How do you know that you still got serviceability? And I often think about this. How much more is there to go? And imagine a good broker will say, well, it depends. And Janine's nodding right now. It depends because I guess it comes down to your asset base and your ability to generate income will be the key determinant of whether or not there's any more finance available to you, even though in a traditional sense you might have hit serviceability buffers. But when do you know personally when enough is enough or too much? Because it still comes down to it's your name that's on the contract, and if you're signing up for money, you're responsible for paying it back. And I think we're a lot better now as as a nation for being accountable for our own personal finances. I think that was born out of the GFC. I think a lot of people went, well, all my money was getting managed by someone else and I had it all in super and they lost all their dough. I think people are a lot more conscious of it. But the other side of that now is I think people may overextend themselves a little bit too much. When do you know someone's a bit overextended? What would you say, Janine? I'll come to you, Frank.
Yeah, I think we definitely saw it sort of coming out of COVID or even just before when rates were really low and everyone could borrow. So if you're borrowing at 2% and now the rates are tripled, then people are really, in the red in terms of bank serviceability. But then I've always done a check with clients as a cash flow check as well. So I think it's really important to hold a good buffer of cash. And I say for me, me personally, I try and keep at least anywhere from 3 to 6 months, and at worst case, and because I knew
of total repayments
just pure repayments, and then like life buffer on top of that. So what I need to.
So are you assuming all your investment properties as well? Like,
yes,
for some people that'd be
quite a bit. Yeah,
it's a big chunk of change,
on top of what net of rent. It's a net of the rental income.
Net of rent, okay.
Because there's always going to be a level of maybe vacancies or a few months where it's.
So assume some income from your rental, but whatever the net is, whatever the gap is, that's negative.
That's right.
Times 3 to 6 times. Okay.
Because we had some real life, like some clients getting into a loan, which I knew would allow them a lot more, but I really did tell them to just keep a really strong cash buffer, which has held them in stead because I knew it wasn't going to service sort of come the rates coming up because it's a commercial style facility. But I know that the banks, if we can show that they have cash to actually make an actual repayment, not on a buffered rate, then we can actually, and that's how we sort of got them through.
What's your clues if someone's sort of getting a bit too overextended?
Sure. Look, the banks all do have their buffers, but people are still able to borrow. And I think a very good gauge for someone that can, assess their own situation is like, are you feeling it? Like, is your buffer reducing? Because if it is, it means you're probably slightly financially stressed and you've probably gone to your limit. So I think that's the best gauge. What
about and I also think about this, and maybe you can give a view as well, Munzurul. If you can continue to increase your debt, so buy more properties and get loans against it, rather than retiring debt. So if you've got money, just say hypothetically you've got all your mortgages offset, but you want to keep your mortgages in place, which is therefore impacting your serviceability, but you can continue to borrow. When do you sort of get to the point where a bank goes, well, we don't need to give you any more debt because you've got 5, 6, 10, 20 other loans which are all offset and therefore you obviously don't need the debt? Does it ever get to a point where the lender goes, no, I'm not giving you any money, you don't need it? Like, does that happen, Munz?
It does, actually. It does, because I've got a couple of very large clients as an example, and this client has got a massive debts, but you've got the whole thing sort of sitting into the offset account, right? And then when you leave that fund into the offset account and you want to borrow more, there got to be a justification behind it, right, where it sort of comes in. Now, I want to also answer that question, if I may, is that when you sort of say, when is it enough? Because it's such an important question, right? So you answered quite a bit, is that when you fill it, a fundamental thing what I look through is that I look through from bank's point of view is that what is my serviceability? What's my buffer right at the end? What's sort of my net position from bank's point of view? Now, bank doesn't end conservative way. There's no question to it, right? I mean, banks sort of assume that everything is P&I. I'm generalizing. Everything is P&I. Banks sort of adds away 2 or 3% extra level of the interest rate. Banks sort of reduce the rent to a certain amount, whether it's 80%. Bank adds away a whole bunch of your other costs, running cost as such. So your rent sort of becomes about 55, 60% when one sort of takes it at a high level, right? So it's a very conservative. We get it. But I'm still very keen to understand what is that net position from the bank. Because I remind this to myself over and over, bank are there to lend. And if the bank is not lending it to myself, then I've got to take a step back and say, why not? And what am I missing, right? Because while you grow with that expansion, is that it's sort of the risk of everything coming back as house of cards. So your mitigation, as an example that Janine says, 3 to 6 months. As an accountant, we say that generally speaking, right? So 3 to 6 months of all of your cost, ideally. But again, it depending on how big the portfolio is. When the portfolio becomes too big, that do we need all of those? And that liquidity doesn't necessarily mean it's just a cash liquidity. It's that accessibility of that liquidity. It could be just a redraw facility that I've got. It could be that I've got fund sitting into the offset account, right? Some level of accessibility.
Okay. I think we've solved all the problems and resolved nothing. No, I do like and enjoy talking mortgage finance with experienced brokers, because you can see how sophisticated it can get, and it's just not as easy as, can you fill out this application, I'll go and get you a home loan. That might work for your first property, but it starts, and I would argue for most investors, once they start owning multiple properties, it becomes very strategic and tactical. You've got to get it right. So thanks for coming in, Frank and Janine. I really enjoyed the chat. You're onto something. These guys know what they're doing, Munzurul.
They're very good.
Yeah,
They're
very good.
very good.
And thanks also for using you as a sort of quasi-example, even though we haven't given any specifics, but sort of at a more sort of... Do you use private lenders? Are you a private lender guy?
I haven't used any private lenders so far. No, I haven't. Lots of my clients use this at different time and favour, right? Particularly with the development side of it. Personally, no, not yet.
No. Oh, there you go. Maybe one day. But we'll keep chatting through all these things. This is In the Balance, the KHI podcast. You can go and tune into it. This is now our fourth episode. We've spoken to financial planners. That's been really cool. We've spoken with Trevor, your partner. We had a really good chat about the origin stories of KHI. We've spoken to some accountants as part of your team. So now mortgage brokers. Yes, Steph and Co. So, really good. So we'll keep bringing the different team members in, because it is a team sport, investing in property, and if you're surrounded by very capable professionals who are able to talk and engage and connect with each other and share their strategies and debate opportunities and challenges, you're going to be in a much better position. But I do preface that with the point of view that you are responsible. If you're the investor, you've got to make the final call. So surround yourself with the right people to give you the informed information that you need so you can make informed decisions. That's what the best investors do. Munzurul, if people want to track you guys down, how do they find you?
In our website, khipartners.com.au or admin@khipartners.com.au.
There you go. Admin at KHI Kilo Hotel India partners.com.au.
That's it.
There
Perfect.
you go. All right. Thanks again, team, for coming in. Stay with us. We'll be recording right through the break as well. So if you want to start binging on the In the Balance podcast, please do. There'll be more coming. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.